Welcome back to another episode of Not Financial Advice. My name is Sean, and today we're going to be talking about all things China. But to start, as we often do, let's take a look inside together my entire stock portfolio. Today is Friday, January 19th, 2024. What's moving the market today is that the market itself has hit all-time intraday highs, not only in the S&P, but also in the NASDAQ. First time since late 2021, so for the first time in about 3 years. On the tails of issues with Apple early this year, growth slowing, a lawsuit over a watch, things of that nature. Apple being the largest component of the S&P 500 weighed things down for the first week and a half or so in the market. But recently, Apple was upgraded, and the other major components of the S&P have followed suit, leading to this rally. So I'll ask you to like the video and subscribe to the channel, but let's do a quick recap of how my portfolio is doing today, and then we will get into the topic for our discussion. So today, I'm up about 0.4%, which is good for about $260 of gains. I am pacing the Russell 2000, which is underperforming the NASDAQ, which is up 1.32%. Dow Jones is up 0.93, and the S&P 500 is up 1.02%. Inside my portfolio, which is pretty diversified, we can get a sense of how the market is feeling today. You have a chip company, Intel, up 3.5%, which speaks volumes, possibly in relation to China, as it were, and Taiwan Semiconductor, who just had a really good quarter. But we'll touch on this some more. We also have what's been a theme for the beginning part of this year: cannabis stocks rallying up about 2.2% across the board. I've done a video on that, so I'll leave that in the end screen. Then you have Meta, part of the Magnificent Seven, one of the top 10 components of the S&P, up 2%. And then I'll just note large components of the S&P 500, Alphabet up 1.7%, Apple up 1.4% today after being up 3.5% or so the other day. Also being brought along with it is Berkshire and Amazon down here at just under 1% gains. So real quick, we'll do the last five, or my biggest five laggers of the day. So we have Foot Locker, which is sort of a value slash lower quality, higher yielding at one-time stock, down 2.5%. Dollar General down 2.4%. Coinbase is down 2.4% with Bitcoin falling. A small cap value company, Seneca Foods, is down 2.4%, and then Cummins and Industrial down 1.9%. So we're going to get into today's topic for the video, and it all started with a thought. So a day or two ago, China released their GDP numbers, so the rate at which their entire economy was growing, and they said that it was about 5.6%, and basically no one bought it. And so, disclaimer that I don't usually have to do, this is not a political channel. I'm a registered independent. But with that being said, we've seen a lot of things with China in the last couple of years. We've seen them crack down on big tech. We've seen them do coups against anyone that could oppose the president, dictator, prime minister, whatever his title is. Obviously, we've seen the situation with COVID and questions surrounding that, and then the internment camps against Uyghur Muslims in the western part of their country. And so it's a pretty ugly picture over there. And that's what got me thinking about today's video. So what we're going to go over today is how to profit from the hidden recession in China. And we're going to jump into that right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, guys, as always, if there is a stock or an ETF that you'd like for me to review, you can just go ahead and leave that in the comment section below. I'm going to ask you to like the video and subscribe to the channel if you haven't already, and let's just dive right into it. So we were talking about their report on GDP. They said that they were growing at a rate of 5.6%. For a lot of different reasons, which we're going to see in a few of these short clips. That wasn't believed. But the first thing that I want to do is show a fast clip from Zihan, a gentleman named Zihan. Can't remember his first name, but he does geopolitical type stuff. And basically, the thesis on China is that their population is growing and their middle class is growing. And that's been sort of the consensus for the last since my whole lifetime. Um, and so without any further ado, let's just hear from Zihan here and see what he has to say.
Okay. Here is the new data. And as you can see that the number of children who are under age 5 has just collapsed. And there are now roughly twice as many that are age 15 as there are age 5. What happened back in 2017, well before COVID, is that we had a sudden collapse in the birth rate, roughly 40% over the next 5 years among the Chinese, the ethnic Han population, and more than 50% among a lot of the minorities. And that is before COVID, which saw anecdotally the birth rate drops considerably more, and before COVID, which probably raised the death rate considerably. We're never going to get good data on death rate, or at least not anytime soon, because the Chinese, when they did the reopening, they just stopped collecting the data on deaths and COVID and everything because they didn't want the world to know how many Chinese died, so they don't know. Uh, with this data, this snapshot in time, this is official state data, it's still probably not wildly accurate.
Right. So let's get over here and let's take a look at how the entire US stock market has performed in contrast to a broad index tracking large and mid cap Chinese stocks. That ticker symbol for the VTI equivalent in China is going to be iShares MCHI. And what we can see here is over all time since 2011. Uh, the total US stock market is up 244%, while the total Chinese market is down 31%. Yet they every year come out and say, "Oh, our GDP is growing at 4, 5, 6%." Oftentimes what they report is just double of whatever the United States GDP is. Interestingly enough, and so if their gross domestic product is rising, if they, have a still have a fastly growing population, which is what the perception from decades ago was. If they have a bigger and broadening out of the middle of the class, if all of those things are true, then how in the last 7, 8 years is our market down 32% if all of those things were true? It doesn't necessarily pass a smell test. So we're going to see two more quick clips, and then we're going to dive into this even more. Like the video, subscribe to the channel. Here we go.
I think it's important just to look back 15 years. China's grown its GDP reportedly by over 500% in 15 years. And if you invested in the Shanghai Shenzhen 300 index 15 years ago, you've lost a third of your money. How can you lose a third of your money if the country you invested in is up 500% in GDP? There's only one answer, and it's communism and the state-run economy. Unfortunately, Western investors will not get to benefit from the meteoric growth of China in the last 15 years. But you look at the last 4 years since China implemented the national security law and ruined Hong Kong. The Hang Seng's down 4 years in a row. You've lost 40% of your money investing in Chinese listed equities in Hong Kong, and they're down another 4% this year. And I guess the Hang Seng's almost down 5% this year, and the Shenzhen index down 4% in the first 8.
So yeah, I mean, if you're someone who watches finance videos on YouTube, you'll be very familiar with the saga of Alibaba stock, which is essentially the Amazon of China. And so this was one that that Charlie Munger, who felt very comfortable and felt as if he had an understanding of China, was pretty bullish on. And a lot of people followed Charlie Munger into this trade before getting scared away from it. But what you can see here is Alibaba is down 26% all time, including a 78% drawdown. And so this was actually something that started when the Chinese government disappeared their founder, Jack Ma, the Jeff Bezos of China. And so and this might have been the point when it happened. Alibaba stock drops as China regulators tighten internet scrutiny. So when it comes to tech companies in China, essentially they are puppet corporations of the state. In that sense, it's almost more fascist than communist, if you want to use terms that are relevant. And so yeah, there's been a purge that's been going on, and this is the main lens that most people have looked through China. So just a tangent here. We've got some more content to see here. Stay with me.
And here we are seeing the premier at Davos saying they grew GDP at 5.3%, when every single indicator come on. And no one believes that, but he says it with a straight face. And I think if they're just cheating a little on the number, they can get away with it. If they say it was up 5 when it was probably down 2.5, then no one believes him.
Mm-hmm.
And no one on
you
Wall
say
Street
up 5, it's up
believes.
4.5. Who cares, right?
Yeah, right.
They're probably not the only country fudging some of the numbers.
All right.
That said, when you look at all those things, here's what I view as a problem. You tipped me off for this a few months ago. China has been increasingly stingy or outright blocking the release of certain critical pieces of data through some of these Bloomberg terminal-like clones that they have in China. Are they not?
Yeah, they basically last March of 2023, they severed the data flow. They geo-blocked it from the China mainland of all macro level and micro level data. So now we knew that the data had low fidelity in the first place, but now there just isn't any. We just have to take their word for it.
System's called Wind.
Yeah, well, there were
There's a couple, right?
4 or 5 systems. Wind was the one that.
So yeah, when you look at Alibaba, they're growing at 35% a year, and they're so undervalued. But you have complete, censorship. China reverting to a hermit kingdom, something that's the opposite of how China was in the 70s and 80s. And so the data just can't be believed, as this gentleman said, on the micro or on the macro level. And so that's the topic of today's video, and basically my question is how do we profit from the downfall of China, or how do we profit from the hidden recession in China? And the headline that we can see here is a pretty strong one. Investing in communism never pays. And it just seems so clear when you think about it and you read it. But I think the fact of the matter is this. There are, what is it, a billion plus people in China. Their population growth at one time was seen to be growing. It may be stagnant or shrinking. We don't exactly know, but it's probably shrinking. Their middle class is supposed to be growing. It's probably shrinking, but we don't also know that either. But at the end of the day, China is a big part of the world. It is the number 2 economy in the world, despite them fudging the numbers. Probably somewhat of a distant second to the US if the facts and figures were correct, but they have a large population, and regardless of anything, people across the world are all the same. There is a large population in China. There is a substantial amount of them who are middle class to a Western standard. And all of these things can go up or down by 5%, but there are certain things about human behavior and consumption that remain true. And so now we're going to start answering the question posed in the title of this video: how to profit from the downfall of China, how to profit from the hidden recession in China. And I'm going to be showing you right now. Like the video and subscribe to the channel. So right off the bat, we're taking a look at Nike. Nike stock, ticker symbol NKE. This stock has obviously done great over all times. Over the last 5 years, it has not done as well, up just 26% in the last 5 years, with a drawdown of 43%. Now, why is that? So, Nike is a company that gets about 19% of its revenue from China. And so, with the Alibaba situation and with the prolonged lockdown in China and all of these questions around their transparency, um, it seems as if American based companies that derive a notable amount of their revenue from China have been punished. When you see an earnings report on a company, it can miss earnings by 1/3% and the stock can go down 10%. So when a company has 20% of its revenue coming from China, it certainly can lead the sentiment to help it be cut in half. But at the same time, you know, we can see that this over here on Qualtrum, I'll leave a link for it in the description below, not affiliated with them. You can see that their revenue is growing. You can see that their free cash flow is growing. And so just a quick note on this whole topic. I had this realization, um, China, what do they export? What do they import? And so the idea is that everything's made in China. Sure, at Walmart, but they make textiles. Okay, a 200-year-old industry. They make small consumer electronics. They make precursor chemicals for some of our prescription medication, as well as fentanyl. But at the same time, they don't have as much arable land as the United States. The United States, what do we export? We export energy. We export tanks and jets. We export technology. And we export food. And so this power shift dynamic has just become more and more clear to me. And so I thought that I would look at some of these companies, American companies that have exposure to China that have been dragged down by sentiment but could present a better value. If you find this to be as fascinating as I do, go ahead and like the video and subscribe to the channel. But yeah, let's just take a quick look at Nike again, down almost 50%. Top line revenue is growing, free cash flow is growing. This revenue number, this free cash flow number, I don't see why this should be down necessarily 50%. Their dividends are growing. Their cash and debt is looking stable. Their earning per shares are growing. They're buying back shares. They have about a median ROCE of 22%. They're trading at a historically low valuation. You've got insiders buying $1.2 million of stock at $96, trading at 101. So is that a way to profit from the downfall of China? Next. Next slide, please. Like the video, subscribe to the channel. Starbucks, up a lot over the last infinity period. Not so great over the last 5 years. China, Starbucks, down 25%. Okay. What percent of revenue for Starbucks comes from China? About 15%, give or take. I thought it would have been more, but yeah, it's about 15% according to this. So again, half of it, a little bit less, a little bit more than half of the exposure that Nike has. And then the stock is down about half as well. And so certainly you get 14% of your revenue from China with all these problems. That's certainly weighed down on the stock. But should the stock be down? We're not doing valuations on these. There is one company we're going to cover today. I have done a DCF on. I'll link that as the second video in the end screen. If you'd like to see a review, fair value estimate for either Starbucks or Nikes, just let me know in the comments below. But a great company like Starbucks, down 25%, 14% of their revenue from China. Revenue is going up. They've had some volatility with free cash flow, but it's higher from here to here. Dividends are going up. Debt's going down. Earnings per share are going up. They're dramatically buying back shares. They have a similarly high return on capital, relatively low historic PE valuation. Okay. So that's another thing to think about. Exposure to China through American domiciled corporations. Now, here's the last stock we're going to be sort of having a talk on today, Estee Lauder. This is one that has some of the biggest exposure to China and has had some of the biggest drawdowns, up 15%, up 13,000% or whatever over all times, 1,300% over all time. But a bigger part of their exposure is to China, consumer defensive. And so, this is down 66% from all time. So, 10 years ago, the thought is that the Chinese would be buying Teslas and Gucci bags and things of that nature. But is there not a significant part of China that no matter which direction this thing goes, will be buying makeup and Nikes and Starbucks? I think so. And so this is starting to sort of answer our question. 30% of their revenue comes from China for Estee Lauder. And looking at this company, they've had some negative impacts, but overall you can see revenue up and to the right. You can see they've had issues with free cash flow. I think a lot of this is from China, but it won't last forever. I don't think it's going to last forever. Let's look at it's a massive outlier, and I don't think it's going to last forever. That's just my opinion, not financial advice. Like the video, subscribe to the channel. Um, Earnings per share are going down slightly. This could be an impact from China. But, if their revenue goes down a lot in China, they'll just find greener pastures. Okay. Cash and debt looks okay, not the best. This is actually the least attractive of the two, just from that high level perspective. But you have dividends going up, you've got shares going down, you've got pretty high return on capital, again, in that same range, around 21%. And the valuation historically is not crazy. So a wide moat stock, consumer discretionary, makeup and perfume. Okay, that's Estee Lauder. And so that's sort of the way that we've gone, is the American domiciled companies doing notable amounts of business in China from the least percentage to the highest percentage. So the least with Nike, or Nike and Starbucks similar, and the most there in Estee Lauder. And so that, those are really the thoughts that I wanted to share. I hope that you enjoyed this video. If you found it to be entertaining or entertaining or illuminating, definitely make sure to hit like and subscribe on your way out. If there's any stocks or ETFs that you'd like for me to review, you can just leave that description in the ticker symbol below, the ticker symbol in the description below, rather. And yeah, so we're staying at intraday highs to round out this video, guys. The market's going nuts, up 1.4%. I'm lagging. Um, that's interesting. It says the Russell 2000 is okay. That was a little bit of a glitch, but the market is up 1.2%. I'm up 0.5%. It's good for $330. Rocket ship looking great. That's it. All right. Again, I'm Sean with Not Financial Advice. Thanks so much for tuning in, and I will see you on the next one.